If you own a painting business and you've ever wondered, what is this thing actually worth? This video is for you. Not what you hope it's worth, not what your buddy sold his company for, and not a random rule of thumb. I'm talking about how buyers actually think when they look at a painting business. Because here's the truth. Most owners don't understand valuation, and that costs them money, freedom, and options. If you clicked on this video, you're probably wondering three things. First, how do buyers actually value a painting business? Second, what factors increase or decrease the value? And third, what can I do right now to make my business worth more money, even if I never plan on selling? In this video, I'm going to walk you through the same valuation framework used by buyers and private equity firms, but in plain English. If we've never met before, I'm Daniel Honan. I'm a CPA and former painting business owner. Over the years, I've helped hundreds of painting contractors understand their numbers, build stronger businesses, increase their profit and long-term value. And one thing I've learned is this: a sellable business is always a better business, even if you never sell. Let's start with mindset. When buyers look at your business, they're not asking, how hard does the owner work? They're asking, how risky is the cash flow? Valuation is not emotional. It's risk-adjusted math. Now, here's an important distinction most owners miss. Most buyers in the market are not asset buyers. They're job buyers. They're looking to buy themselves a job, which usually means little or no cash down, seller financing, earnouts, long consulting agreements, and the owners staying heavily involved. That's not who this framework is for. This video is about understanding how asset buyers think. That includes private equity and buyers looking to acquire a business that runs without the owner. Those buyers think in terms of cash at close value. That means no earnouts, no seller financing, no extended consulting periods, just one question. How much cash would I be willing to put down upfront based on the risk and return of this business? Even if you never sell to private equity, building a business that could sell that way makes it more profitable, more stable, and far more enjoyable to own. Every valuation we run breaks into four components. First, baseline value. This starts with revenue, EBITDA, and a baseline multiple. Second component is value adders. These increase the multiple because they reduce risk and improve scalability. Third component is value subtractors. These represent risks that cause buyers to discount the value. Fourth component is final valuation, your adjusted multiple times your EBITDA. Simple framework, powerful implications. Everything starts with EBITDA. EBITDA is your true operating profitability before financing, taxes, and accounting noise. It's similar to net operating profit. It's what buyers care about the most. Then comes the baseline multiple. Smaller businesses get lower multiples because they carry more risk. Larger businesses get higher multiples because they have infrastructure, systems, and stability. This is not opinion, it's market reality. This baseline is just the starting point. What really matters is what moves the multiple. Quick pause. If you want to apply this to your business, instead of just listening to theory, I've built a simple business valuation calculator specifically for painting business owners. It's not complicated, no fluff, just a clear way to see what your business is worth today and what levers would increase that value. You can get it for free by clicking the link in the description. All right, back to the valuation. Buyers pay more for businesses that are predictable and scalable. Here are a few major value drivers: strong revenue growth, repeat or recurring customers, healthy EBITDA margins, efficient marketing, clean, reliable financial data. All of these signal one thing: future cash flow is reliable. That increases valuation multiples. Now let's talk about risk. Risk is what reduces value. The biggest one, owner dependence. If the business falls apart without you, buyers discount heavily. Other common risks: one client makes up too much of your revenue. Think one GC you do a lot of work for. One marketing channel drives most leads. Weak or messy financials. No documented processes. Here's the important part. These are not criticisms. They're opportunities. Every risk you remove makes the business easier to run today and more valuable tomorrow. Once adders and subtractors are applied, buyers arrive at an adjusted multiple. That multiple reflects how risky or stable your business is. Multiply that by EBITDA and you get enterprise value. That number represents what a buyer might pay upfront in cash based on today's risk profile. If the number is lower than expected, it doesn't mean your business is bad. It means buyers would require more protection to offset that risk. Now, let me show you exactly how this works in real life. I'm gonna go to share my screen and walk through a simple example using the free valuation calculator I mentioned earlier. This is the same tool we use with painting business owners to get clarity fast. All right, here we are on the business valuation calculator. Let's take an example. Let's say you have a $2 million painting business. So we'll enter the revenue here. Then we have this business is doing about 25% margin. So they're making $500,000 in net operating profit, or EBITDA. Now from there, we add in the value adders. Let's say this business is growing relatively quickly and at 30% growth year over year. So we click this item here. They do not have repeat customers of over 80%. They do not have EBITDA margin over 30%. And their GP to CAC ratio, let's say, is 5-1, which is still really good, but not 10 or better. So they don't get any other value adders. Then from there, we scroll down to risk assessment and we add in the risks. So this painting business owner, the business is not dependent on him. He doesn't do any key role, like he's not the salesperson, he's not the production manager, he's not obviously painting on the job site. So he has no key man risk here. He doesn't have any key client risks. No single customer that he has provides over 20% of the revenue, so no risk there. But he does have single channel risk, meaning that he has Facebook ads, and that provides over 80% of his leads. So we have to ding him here on single channel risk. There's no market risk, and he has Profitable Painter CPA taking care of his books, so he has no data risk. All right, so with that, we can scroll back up to the top and see that he gets a 1 multiple here based off of his EBITDA, and then he gets a value adder point as well, which gives him up to 2 multiples, but he has that risk of single channel risk, so that subtracts his multiple down and gets an adjusted multiple of 1. So his total enterprise value is $500,000. Now, let's say $500,000 isn't bad, but he can improve this business by adding in an additional marketing channel. So let's say in the next year he does that. He adds in door-to-door marketing along with his Facebook ads, and then he also has referral-based marketing as well. And so we remove that risk here, and what that does is increases his multiple, his adjusted multiple, to 2, and now his business is worth $1 million. Not too bad. Nothing magical happened. No hustle, no selling the business, no complex financial engineering, just reduced risk. That's how buyers think. Here's the most important part. Valuation is not about selling. It's about clarity. Once you know what increases value, what decreases value, you know exactly where to focus. Increase EBITDA, reduce owner dependence, build systems, diversify marketing, clean up financials. Every one of those improves life today, increases income, and raises valuation. Let's recap. Buyers value painting businesses based on risk and cash flow. Valuation starts with EBITDA, but is driven by systems, predictability, and independence. A more valuable business is one that runs without you and produces consistent profit. Even if you never sell, this framework makes you a better owner. If you want to know what your painting business is actually worth, don't guess. Use the free valuation calculator linked in the description. It will help you understand your current valuation, what's helping you, and what's holding you back. That clarity alone changes how you run the business.